Welcome, everyone. Welcome to today's webinar, sponsored by Moss Adams and TriNet, on research and development tax credits for life science companies. I think it goes without saying that this is an unprecedented situation. I'm working from my home in Oakland, presenting this webinar, as the Bay Area is in lockdown in an attempt to contain the spread of the coronavirus. I suspect that most of you are as well. So given the unusual circumstances, I just want to start off with a few things. Forgive us if there's any unusual background noises, as some of us are at home with pets and or small children. And also, it's also a little fortuitous that we have TriNet presenting with us today. As I know, as I've been fielding a lot of questions from clients, and we've been working through issues as a firm, HR issues. What do we do with people, working remotely? How do we get on top? Great to have them here presenting with us today. Today, though, we are going to devote the next hour to talking about the research tax credit and how life science companies in particular can benefit from the research credit. My name is Richard Croghan, and I am the Life Science National Practice Leaders for Moss Adams. As I mentioned, I'm here in the Bay Area, and joining us today will be May Lee and Ray Esquivel from our R&D Tax Services team, both located here in the Bay Area. Also, we have the pleasure of having John Littler from TriNet joining us today. Our agenda for today, we'll have May go over the research credit, just to provide an overview of the research credit in general. Then Ray will take over and talk about how how companies can use those credits to offset their payroll taxes and then reduce their cost for continuing research. Then we'll turn it over to John to talk about how this credit coordinates with the HR function and how companies actually receive the benefit. We will then move on to questions, and then we'll also wrap up with a bit of a discussion about TriNet and Moss Adams and really some current developments that aren't specifically related to the research tax credits, but we know that there's lots of discussions on, and in these times it's good, that would be good to a few minutes of overview of real current events. So with that, we'd like to start off the technical discussion, and I'll turn it over to May Lee.
Thanks, Rich. Hi, everyone. I hope you're doing well and you're ready to learn about some R&D credits. Before we move through the slides, we thought it might be useful to give you all a little history about the credit's origin. Congress had passed the Economic Recovery Act of 1981 with the intent of it being a stimulus to a depressed economy and encourage investment within the United States. As part of this act, the R&D credit was enacted to incentivize companies to invest in and increase U.S. research spending year over year, so long as the company meets certain qualifications defined by the tax law, and we'll talk about those later on. Traditionally, the credit is applied towards the company's tax liability, and any unused credits would carry forward to offset your future tax liabilities. But there is a relatively new application in the form of payroll tax credits that Ray will talk about. And throughout its life, the R&D tax credit has expired and it's been renewed many times. I believe the count is somewhere along the lines of 8 times expired or 15 to 16 times extended. But in general, it's played its part over the years to encourage R&D spend, which has led to a lot of the advancements in technology that we've been able to see and experience throughout the years. And the great news is that the recent PATH Act, which was enacted on December 18, 2015, permanently extended the research and development tax credit for us. Now, the big question is, what are qualifying activities? And this is an important slide that I'll spend a little bit more time on, which is why it's the very first slide. In order to qualify for the R&D tax credit, the taxpayer has to first determine which of its projects or activities qualify for the credit, because this is, after all, an activity-based tax credit. The projects or activities, which again all have to be performed within the United States, have to meet all the requirements described in Code Section 41D, and this is what we commonly refer to as the four-part test that you see here. The activity and the related expenses have to be undertaken for the purpose of discovering information, which is technological in nature, and that's the third bullet point that you see. The activity is technological in nature if it relies on the principles of physical or biological sciences, engineering, or computer science. Now, that information that's discovered is then intended to be useful in the development of a new or improved business component. In other words, your product or process, and substantially all the activities constitute elements of a process of experimentation for a qualified purpose. And that process of experimentation is for purposes of evaluating alternatives through, for example, your modeling, simulation, or systematic trial and error methodology to evaluate one or more alternatives to eliminate technical uncertainty related to your results. And in this case, the success or failure of these development activities doesn't impact your company's ability to claim the credit. Now, with respect to the life sciences industry, there is a lot of R&D that takes place to vet and launch each product. With the reality of COVID-19 on everyone's mind, I was following the development of a treatment with Gilead's remdesivir, and all of the scientists working on the compound to evaluate its antiviral properties, test it, realizing the formula isn't quite right, changing the formula and retesting it. It's a very tedious process with a lot of failures along the way, but it's a very real example of development activity that spans this four-part test. Now, the activities performed to develop a new or enhanced product can extend beyond what is thought of as your traditional development in the form of your chemist and your biologist creating a drug in a lab setting into other aspects of the business, such as manufacturing the drug and testing it for regulatory approval. But it is important that we are able to connect the employee's activities performed to the development of a particular business component. Again, that could be your product or process. And then to take this one step further, the four-part test describes activities performed by your core development team. In addition to the scientists and engineers, we can actually also include the qualifying activities performed by individuals in direct support of the developers. Examples are individuals who are preparing the test equipment for the scientists to conduct testing, or an administrative assistant who's documenting the development process for the engineers. Lastly, we can include the direct supervisor or first-line manager of the individual performing core development. And this supervisor, regardless of the job title, would be performing activities such as providing technical guidance and direction for your core developers. And then our last bullet point on this slide is regarding internal use software. If the company is developing internal use software, or IUS, there are some additional thresholds that would apply. This type of software is developed for general and administrative functions in the form of financial management, human resource management, and support service functions that are for day-to-day operations such as data processing. But in addition to the four-part test, internal use software does have to meet some additional criteria. It's actually an additional 3 parts. It has to be intended to be innovative as measured by a reduction in cost, improvement in speed, or other measurable improvement. The development has a significant economic risk that your resources that were invested might not be recovered within a reasonable time. And finally, the software is not commercially available. So now that we know how to identify the qualified activities performed, how do we actually quantify this? First and foremost, we rely on your Form W-2 Box 1 wages, which is typically the largest component of your qualified research expenses, or QREs. So for example, let's say that somebody spent 50% of their time in a given year on Project X, doing qualified development, then the company can claim 50% of that employee's Box 1 wages. If, however, that percentage happens to creep up to 80% or higher, the law actually states that we can claim 100% of that individual's wages, and that's known as the 80-20 rule. In addition to wages, we can also claim any supplies that are consumed in the development process. For example, your test tubes, chemicals, and prototypes, just to name a few. We can claim rental or lease costs of computers, which in a cloud-driven environment, we see a lot of Amazon Web Services or Google for cloud computing that's used to host your software test environment. We just need to analyze what portion is truly dedicated to development as opposed to hosting for a mature production environment. And then the last eligible R&D cost that we have here is your third-party contractor research, and these are contractors that are engaged to assist in the design or development of a product, so long as the company maintains the financial risk of the development cost and retains the rights to the IP. So don't forget that all the costs, just as it is with the activities, have to be used in the United States. So now that we have all the main components of the credit identified, let's talk about the calculations. There are different ways to compute your credit, which yield results ranging from 6% to 14% of your QREs, or qualified research expenses. The regular research credit method is 20% of a taxpayer's current year QREs in excess of a base amount, which for many companies will yield a credit of equal to 10% of your qualified research expenses. Since 2007, taxpayers have been able to elect the alternative simplified method, credit method, which equals 14% of your QREs in excess of the base amount. And then if the taxpayer has no QREs in any one of the preceding tax years, then the alternative simplified credit rate equals 6% of your QREs for the credit year. So we have identified the qualified activities and the eligible costs associated with development. We've calculated the credit, but we need to prove it out. These credits can be audited at any time, but if it's being utilized, then your chances are, obviously much higher that you'll be asked to show documentation to support your credit claim. Because without it, you basically are not entitled to any of the credits, meaning it can be completely disallowed, and we just don't want that to happen. So I've been an R&D tax credit specialist for almost 20 years now, and I've worked with many companies across many different industries. And there really isn't a one-size-fits-all approach. And unfortunately, the burden of proof rests with the taxpayer. Some companies will have detailed time tracking for R&D projects and expenses, but others won't. In general, though, you want to capture key information on the expenses that we had talked about in the earlier slide, including your Form W-2 Box 1 wages by employee, as well as a good record of the supplies, computer lease expenses, and contract research expenses for the quantitative documentation. For the qualitative documentation, we really want to show that there were steps and checkpoints throughout the development process that can be in the form of your project plans, your project specifications, presentations, test results. And this documentation is, again, going to vary by industry, but the key is to prove that your activities meet the four-part test. And with respect to the final item, contract, we generally like to look at these to determine if any of the development is funded by a third party, which might prevent your company from claiming the expense for your credit. So the key takeaway of this slide here is just to document it all. Make it nice and easy for you guys.
So May, let me jump in here. We got a number of questions coming in, which is great. I didn't even do an intro or an overview on how to access the Q&A function, and a number of you have already figured that out. But we got a question. Someone missed, what does QRE stand for?
QRE stands for your qualified research expenses, and these were the wages that I mentioned earlier, your supply expenses that were used for developing your product, and the contract research expenses, as well as the computer lease hosting expenses.
Great, thanks. And another person's asking, do any capital equipment costs qualify?
That's a great question. I get that one a lot. We do not take the capital equipment, the big machinery that you have to depreciate, amortize and depreciate over time. These are the only includable QREs are expenses. So these are your tools that you're utilizing in the moment for the development, prototype expenses, things like that.
Also saw another person asked, what are some examples of non-qualifying activity?
Another good question. So non-qualifying activities would be your general administrative activities, HR-related functions. Also, a lot of times we get questions about maintenance. We really want to think of qualified activities of the activities that take place during the development process, which is from your idea conception when you say, I have an idea, let's develop this, let's create the specifications and requirements, all the way through to the point where the product is marked as ready for production. As soon as you say development is done, that's our cutoff point. If there is general maintenance to maintain a mature product, that would be a non-qualified activity as well. And then, as I mentioned earlier, this is a U.S.-based tax credit, so any foreign activity would also be disqualified, even if it is development.
Okay, and along those lines, I got a question that came in about clinical trial costs conducted in foreign countries. So again, would that be allowed to be part of the U.S. credit?
If it's foreign-based, then we will exclude it.
Okay. Questions coming in right and left. I like it. An engaged audience. Very interested.
I love it. I appreciate the question.
Someone wanted to understand again how the determine what percentage of QREs to use.
Understanding what percentage of QREs we use. Okay, so
because you had mentioned like 6 or 10 or 14. Yeah.
Yeah, so there are different methods of computing your credit. Generally, when we come in and we do a review, we will analyze it under the regular research credit as well as the alternative simplified credit to see which one is most beneficial to you. In general, though, as I said, with the regular research credit, once you run it through the computation, it's a good gauge to say you get about 10% of your QREs. So if somebody has spent $1 million on development, 10% of that, you get about $100,000 in credit, give or take. Okay,
thanks. Someone had mentioned that I might be having an echo, so I apologize for that. Annoying. One more question, and then we'll move on. If your questions are in the queue, we'll answer. We will answer them. But the last question I wanted to get to before we moved on. We have a federal research grant. Does that affect the ability to claim?
I'm sorry, Rich, you cut out on that one.
Sorry about that. The question came in, if we have a federal research grant, does that affect the ability to claim a credit?
If you have a federal research grant, I think Ray would actually be best suited to answer that question.
Yeah, so those are going to be the areas where we think about the funded research provisions that are included in the credit rules, which effectively monitor and enforce, who is on the hook financially for the research that is occurring. So in that instance, you would run into problems as far as the dollars that are being used to fund the company's research being provided by some outside third party, and therefore not coming from the company itself, and therefore having to be excluded from the calculation of the QREs. So to the extent that you do realize that benefit, that's something that we typically dig into pretty good in terms of how that translates as far as what the company resources that are being utilized and how those funds are being allocated as part of the development program, to be able to exclude that properly so that it's not violating the provisions as they stand right now for funded research.
Thanks, Ray.
All right, so I'm trying to move things around because I've had another comment about being able to hear me. So with that, I mean, we've had a bunch of questions. There's still some more in the queue. We'll get back to you either by the end of this call or after the call. We'll have someone connect with you. But for now, we're going to move on to the next part of the agenda, and the one that offers some immediate benefit to a lot of life science companies, and that's the ability to use these credits to offset their payroll taxes. So Ray, you want to take it from here?
Sure. Okay, so I think we are going to go past the examples. So we've talked a bit about the qualification and identifying the applicable costs that we're most concerned with when it comes to calculating the credit. Talking about the mechanics behind the credit calculation and what that translates to from a dollar perspective as far as the credits are concerned. And so there's the important PATH Act that May was referring to, as we had mentioned, as far as the introduction and release of that in December of 2015, that's Protecting Americans from Tax Hikes Act that Congress passed, and there were a number of very important provisions that were passed in that legislation that we care very much about in the R&D tax credit world, because one, as we've discussed previously, the credit was made permanent as part of that. So prior to that, we had to wait every year to ensure that it was extended. And so thankfully, that's no longer part of our annual routine. We can look to the PATH Act to provide the guidance that we need to ensure that this benefit is one that will be available to us going forward. The other one that is most impactful that we've been seeing more recently is with respect to the payroll tax offsets. And effectively what that's intended to do is to provide another option or alternative for companies to be able to monetize this credit. Essentially, what it's doing is opening up a new avenue in terms of the dollars that are translated from this, from a benefit perspective, from these R&D tax credits. The traditional regime, prior to the PATH Act, the way that worked is I think May has already alluded to that as far as the applicability and the use of these credits against taxable income once the company realizes that over its time. So Prior to the PATH Act, you had to wait for that taxable income point to occur to be able to be showing that on the income tax return, and at that point is when the credits are begin to be utilized. Anything that is generated prior to that point is tracked as part of your R&D tax credit carry forward, and you bank those away until that taxable income point is reached. And then at that point is when you would start to utilize those credits from the first in, first out basis. So what the PATH Act says is that we are going to now, assuming that you meet the criteria that we'll walk through here in a second, we will allow companies to make an election on the income tax return that says we would like to use our R&D tax credit to offset payroll taxes rather than income tax. So it's an incredible benefit for startup companies that otherwise would not be in that taxable income position for a good amount of time, giving them the benefit of the R&D tax credit and a way to monetize that credit on a more immediate basis, and therefore help the business through those initial stages of development. So just talking specifically again about the payroll tax offset regime, the four-part test that May described in the first section, that is going to be applicable across the board. So that's going to be applied to any R&D tax credit, whether that's your traditional non-payroll tax, income tax only, or the payroll tax offset version. That baseline four-part test is going to be applicable across the board. What the rules under the PATH Act provide is that they are giving essentially two more additional hurdles to clear to be able to show that you're eligible as a qualified small business. And so what those provisions say is that it looks to a couple of different areas. One is the current year that the credit is going to be claimed on the income tax return, ensuring that the company's gross receipts for that year are less than $5 million. Secondly, what this PATH Act is intended to incentivize is for companies that are small business, that are startups in that phase. And the way that they're measuring that is that they're looking at the company's gross receipts history, and specifically looking at a 5-year window that ends with the income tax, the year that the income tax return is filed and the credit's being generated. So as long as the company does not have gross receipts prior to that 5-year window, then they will be eligible. So if you've got, if you're claiming a credit for 2019, we're founded in 2017, and we have some interest income or some other gross receipts, that would be okay. For purposes of the 2019 credit, if you've got gross receipts, say from 2013 or 2014, or any kind of other interest or other income that's showing on your income tax returns from that period of time, that would be limiting. And so that's how the PATH Act judges or makes that distinction in terms of what's a qualified small business, and that is within the realm of the startup realm that they're trying to target here. So the qualifying research activities and expenditures would need to be analyzed in the same way that May has described in the previous section, thinking about what is being qualified from a wage perspective, consumable supplies, contractor expenses, and any computer leasing or hosting expenses that may be being used for R&D purposes. The other important point to remember is that there is a maximum limit in terms of the amount of payroll tax credit that you can claim in a given year. That amount is $250,000. And so on the income tax return, there will be a box now that is on the form itself, that is Form 6765, where the R&D tax credit is claimed. The last section of that is where there's a box that's checked, and you elect the actual amount that you want to apply to the payroll tax offset. Now, in the instance that you have an amount greater than 250,000 that you're calculating as a credit, let's say you've got 450, the election is still made, and you notate the 250 as the elected amount for the payroll tax offset. That remaining amount, that excess amount of 200 in our example, will be tracked separately as your R&D tax credit carry forward that will be applicable to income taxes, again, under that older R&D credit regime that was existing prior to the PATH Act, so that, again, when the company starts to realize taxable income, that R&D tax credit carry forward bank is what would be utilized to offset that taxable income at that point. So again, major take homes here as far as the annual limitation, as far as the amount of available R&D tax credit that's available on form of a payroll tax offset being 250,000, and then thinking about current year gross receipts being less than 5 million, and then having a gross receipts history that doesn't precede the 5-year window that ends with the current tax year. So what we're trying to show on this slide is just to try to give a sense for some of the rules that I just walked through as far as how we put this all together from a QRE and resulting credit standpoint. So the example that we have presented is assuming qualified expenditures, wages, supplies, contractor expenses that amount to roughly, let's say, 2.5 million. As May was mentioning, typically most companies at this phase in the history for the companies will realize a benefit of roughly 10%, and so using that QRE amount, getting to our 250,000 of federal credit. Important to also note that we're also going to be doing a similar analysis when we think about state credits. However, the payroll tax offset is only a federal benefit, so it's only generated in conjunction with the federal R&D tax credit claim. The state credits, so like, for example, California, what would happen there is that the entire amount that's generated as a state credit would continue to carry forward and be applicable to income taxes only. So as far as the example that we have, we're assuming that this is a startup company with no income tax in a loss position, but a total payroll of roughly 4 million that would, over the course of that year, generate a total payroll tax amount of roughly 248,000. The R&D credit election of the full 250,000 would be available to the company in this year. And that would be applicable to the payroll taxes that start would be showing on the company's Form 941 payroll tax returns. The other important thing that I wanted to mention on this slide is just from a timing perspective. And I think John may be touching upon this in a bit on his slides as far as the submissions that are needed for the payroll tax offset. But I think it's crucial to get these points locked down as well as far as from a timing perspective, how does this all fit together? How does it work? So again, we'll use a 2019 income tax return and credit as our example. The rules say that the credit is claimed on the income tax return, and the timing at which that income tax return is filed really starts the clock, and it really starts the process as far as how the payroll tax offsets are realized. So let's just use an example of if the income tax return for 2019 was filed today on March 19th. What the rules say is it looks to the filing of that income tax return and says what is the next calendar quarter for payroll tax returns that are filed, and it is at that point in that particular quarter that that quarter's payroll tax that would be eligible for offset with the use of these R&D tax credits that are filed with this 2019 income tax return. So for our example, what we would look to is the company's portion of the Social Security liability for Q2 specifically. So that amount is what we would be targeting as far as identifying what would be eligible for offset, and then that would be eventually realized in the form of a benefit that would be coming from the R&D tax credit. So from a timing perspective, if we think about that, how that unfolds, Q2 ends at the end of June. Those returns are typically filed in July. And so, that at that point is when we start to see exactly how much that amount is for Q2, and then you get a sense for what the return will be as far as the credit is concerned. So in our example, we're using, on this slide, we're assuming payroll taxes of roughly $248,000. Obviously, that's for smaller companies, that's not going to be the case for a particular, an initial quarter. And that's okay. The rules dictate that to the extent that you have an amount that is available after the application of this first calendar quarter, any excess that you have in excess of that first calendar quarter, so for us for Q2 in our example, would carry forward to the next calendar quarter. And so you have that ability to utilize that credit to its fullest extent. It's not a use it or lose it in that first quarter type of scenario. It is something that can be utilized in subsequent quarters. The key there is just to be mindful of the amount that is being utilized over time, so that that the credits are properly tracked and utilized properly as far as the subsequent quarters. So just a few summary points to mention here, and these really are the key takeaways when we're talking specifically about the payroll tax component of the R&D credit. We want to be mindful of that $250,000 limitation and cap for a particular year. Again, that gets filed with the income tax return, and you're able to do that for up to 5 years. So that's where we get that $1.25 million number in terms of the full benefit that a company, assuming they take advantage of this for the 5 years that they're able to do so, that would be the resulting benefit that they would see against payroll tax. Again, as far as the limitations specific to the payroll tax are concerned, we're thinking specifically about current year revenue and gross receipts, and making sure that those are less than $5 million. And that the company is not in a position where they've been realizing gross receipts for more than 5 years. As we've talked about before, there is a heightened effort as far as, there should be a heightened effort as far as the documentation of these credits, especially given the intention to utilize and monetize these credits and the scrutiny that we'll see from the service. Where these amounts are concerned as far as the utilization and seeing actual return on these credits. So that's where the documentation, both for the quantitative side, asking the right questions as far as, are we including the right types of costs? Are we including them in a way that is that aligns with that 4-part test correctly? Are we taking in all of the R&D tax credit provisions into consideration properly, and then coming up with our qualified research expenses as a result of that? And then from a qualitative perspective, do we have those items that May was walking through in our first section that really demonstrate and paint the picture of the company's development year, and why these expenses that we're including in our credit claim are in fact qualified. So, the wages and that we're paying, the underlying activities that those employees are performing, what are they doing in conjunction with our development programs, and how is it or why is it that time that we're including for them is qualified. Similar analysis for contractors, looking at what they are doing, where they're doing the work, and ensuring that that's all qualified as well. So.
All right, Ray, that was great, and especially that last point with documenting the credits. I know that the service is very sensitive about trust fund taxes, Social Security taxes in particular. So that documentation is essential. We continue to get some additional questions, so I wanted to bounce them off of you. One question: can you carry back the credits?
So payroll tax credit. So for the payroll tax offset, you need to claim it on on the current year tax return. So you, again, if we're using 2019, if you discover, oh wait, we had credits that we were eligible for payroll offset back in 2018, but we did not make that election on the originally filed return. In that instance, you would not be able to go back in time to recapture those credits. You have to make that election on the original income tax return that says, hey, IRS, we are claiming the payroll tax offset in the amount of $250,000 for the 2019 credit.
But you can't use it to amend prior period payroll tax returns and get money back, correct?
Right.
You can't carry it back to prior quarters.
Right.
Okay. Another question was, how many years can you carry the excess amount forward? You had mentioned in your example, claiming $250 on the tax return and then applying it to offset $248,000 worth of payroll taxes. That $2,000, how many years can that be carried forward to?
As of right now, the guidance that we have doesn't specify a sunset provision as far as those expiring at any point. The applicable sections on that talk specifically to the next calendar quarter, and the rules essentially leave it at that. So I think buried in that is the assumption that these are going to be utilized continuously. And at a rate that that wouldn't exceed the current expiration timeframes that we typically think about for R&D tax credits in the 20-year range. That's not something that would be that was thought to be applicable here. So the rules look to just applying it on a continuous basis on the next calendar quarter, and they essentially leave it at that.
Okay, and one more question, and then we'll move on to the next part of the agenda.
Sure.
So once a company hits that $5 million of revenue, can they still utilize the credits that are on their payroll tax, the payroll tax offset, or does that stop?
Great question. So if you have an available credit balance to you from a prior year that was generated that payroll tax offset, you can still continue to use that amount. So again, using our example of 2019, if in 2019 we're north of that 5 million number, but we still have $100,000 of credits that were left over from the 2018 year, you are allowed to continue to use that 100,000 even though in that 2019 year you have exceeded that $5 million threshold for 2019. So that $5 million threshold is applicable for the current tax year, and your eligibility for credits that are claimed on that 2019 income tax return. Those would not be applicable to the 2018 because at that point you still were an eligible qualified small business at that point.
Okay. All right, great. Thanks, Ray. So we're going to move forward on to the next part of the agenda. And with that, I'm going to turn it over to John Littler from TriNet, and how all this work that we just talked about, the activities that you have, and companies can generate these credits. TriNet, I know, works with a number of our companies, and as a PEO, and really works through the payroll tax filing. So we wanted TriNet to kind of weigh in on how they work together, how we work with them, and how they handle this for their clients. So John?
Great. Thanks, Rich. Thanks, Ray. Really appreciate it. So now you've gone through the process of going through the R&D Tax Credit Assessment, which is formerly known as 6765, and now it becomes important to ensure your payroll and HR provider has that expertise to handle the R&D tax credit so you can actually realize that benefit. So a few things have to happen. First is with your HR provider, they should receive the 6765 document from Moss Adams. And then from that point, your payroll and HR provider will work with you to complete the 8974. That's an important document that's actually going to illustrate and provide the information that's going to be the payroll offset figure. And that is then submitted to the IRS along with your 941 quarterly payroll tax return. So once that's submitted for that respective quarter, it does take the IRS roughly about 90 to 120 days to circle back and validate that the credit was approved. And then once that's done, your payroll and HR provider reflects that credit against your payroll taxes. And that becomes important for a couple things. One, you want to ensure that you're dealing with the HR payroll provider that is actually going to be familiar with submitting the proper documentation and then ensuring that you're going to get that and see that credit visually on your payroll taxes. So in that particular case, that additional work that's done, it should be done without a processing fee. All the work's being done in the completion of the 6765. So this is just an administrative function that's just ensuring that all the proper documentation and the compliance pieces are being met on the payroll part of it, and then in fact then returned. Once it's notified, you should see that credit immediately against your payroll taxes. Now it does become important, I think a couple of questions came up, that with your HR and payroll provider, there will be at times when your credit will actually exceed the taxes for that particular quarter. And as Ray mentioned, you can actually carry that excess into the next quarter or into the next year. One of the things you want to ensure that that payroll and HR provider is going to do that automatically so that you are realizing as a company exhausting that full R&D tax credit on the payroll component to it without having to remember and feel confident that's going to be exhausted and you maximize the credit there. We wanted to give you a few examples of some of the life science companies that have experienced the taking full advantage of the payroll offset. So in the medical devices space, we had a company commercialize a collection of catheter-based tools used to treat atrial fibrillation pursued, and then they recently secured $150,000 in the R&D tax credit space. In biosciences, we had a company pioneer treatment of classical complement-mediated autoimmune and neurodegenerative diseases. They realized over $205,000 in R&D tax credit for the payroll taxes. These are pretty significant figures that are coming from the payroll part of it. And then lastly, in the biotechnology space, we had a company develop biologics to address medical conditions where there is significant unmet need, and in that process, the company received R&D payroll credit tax reduction of $218,000. So just be mindful of, if you're not sure really what that means, it's worth going through a 30-minute assessment, just kind of getting a sense of what potentially could be the credit. And in these three cases, clients have exceeded over $500,000 in payroll offset credits over the last 12 months. So pretty significant in terms of the impact that it could have on your business.
Thanks, John. Yeah, that's great. I mean, I think that's a great point about how the benefit goes to companies so that they can continue their research. Maybe hire another researcher. So I think the intent and the application of this provision is really meeting the intents provided for in the legislation. So with that, I want to talk a little bit about TriNet and Moss Adams, a quick overview, and also kind of what we're, some issues that we're dealing with currently. Not something that we would really plan on 2 months ago when we thought about this, but thought it would be good to give an overview of services just so you can better understand what we do. So so John, why don't you give a quick overview of TriNet and kind of the issues that you're seeing these days?
Absolutely. So about TriNet, so those not familiar, we are a nationally publicly held PEO company on the New York Stock Exchange that services over 18,000 clients as well as 340,000 worksite employees. And our strategic marketing goes to market in a verticalized service approach where we're offering access to benefit options, HR expertise, obviously with the COVID-19, big topic of discussion on everyone's mind today, payroll services, risk mitigation, and an amazing technology platform where this is all navigated. With specific to life sciences, we're partnering with leading startup life sciences and biotech companies as their strategic partner by helping them lower their burn rate and scale factor to deliver on their mission. And additionally, our turnkey solution is encompassing benefit services, technology applications to help the company, reduce their administrative burden and increase those operational efficiencies. In turn, the company's focusing on high value added services instead. The three key components where TriNet service offerings are really specific to life sciences is really when you think about for any life science company to succeed, they must have the right team to build that next generation product, platform, or drug. And in the life sciences, the competition for top talent is fierce. So we're helping them startup companies provide a comparable level of benefit options as big pharma like Pfizer and Amgen, for example, that spans a large group of medical benefits, dental, vision, retirement options, short and long-term disability, and even pet insurance, just to name a few. Secondly, one of the most important responsibilities of any CEO, CFO at life science companies is the raising funds, rounds of funding. So to protect their valuation, our life science clients have access to a number of risk mitigation services, EPLI, training, employee benefits, policies, and HR guidance to help them navigate these critical issues and ever-changing employment laws so that they can stay compliant and avoid expensive employment-related charges. For example, how to deal with the crisis like we are today with COVID-19. And then lastly, the data and technology are playing an important role across many facets of the business, including HR, where the clients are having access to a number of analytics and applications to empower them in running their business. The best example I can give you there is just benchmarking to provide insights on competitive salary and benefit skills and trends by region to help a company see how it compares to its competitors. So in a nutshell, basically, based on the third-party independent study, NAPIO, a company utilizing a PEO can experience return on their investment with cost savings alone of approximately 27% compared to other traditional HR models. The favorable return was experienced in faster growth, higher employee retention, on average, lower cost per employee. And so for those same companies benefiting from the PEO solution, 98% of them would, in fact, go ahead and recommend a PEO solution to their business colleagues. So if you would like to learn more about TriNet, feel free to explore TriNet at www.trinet.com. And at the end, you'll see my telephone number and email address. Feel free to contact me directly. Thank you, Rich.
All right. Thanks, John. Now I'm trying. So now about Moss Adams. We're a full-service accounting firm. We're about 3,500 people. We're West Coast based. Washington, Oregon, California, Arizona, Texas, Colorado, New Mexico is where we have offices, about 30 offices. We align with various industries, life sciences being one of the larger industries that we work with. We have over 500 clients, and and those clients are at all phases from early stage startup up through public companies. We serve more life science companies than any other firm other than the Big Four. And why that's helpful is that we've seen a lot, and we have comparisons to use to your advantage. And we scale with companies. You know, how we serve a new startup is different than how we serve a public company. We know that, and so we can help you start with you early and then grow with you. And as I mentioned, we're a full-scale accounting firm. We provide audit, tax, and advisory services. On the tax side, we do federal, state, and international compliance and consulting. On the assurance side, we do financial statement audits. We do employee benefit plan audits. We do government grant audits if you're receiving government grants. On the advisory side, cybersecurity is a big issue with companies these days, even more so with everybody working remotely. Enterprise systems. We work with a lot of companies to help them with the selection process, analyzing where you want to go after QuickBooks. Most companies start off on QuickBooks. We understand that. And then we also help with implementation. And we do a lot of that work. And interestingly enough, that type of work a lot of people are focusing on now as people are working remotely, as some people are having a little more time on their hands. We also provide technical accounting, whether it's RevRec or lease accounting or just complicated transactions, and you need some help with respect to your audit. We have a team that jumps in and helps people on that. And then as you get larger and grow and you need SOX services, we have a large SOX group that helps people comply with SOX. We generally work with companies before they go public, as that's a better practice. And we also help companies get ready for an IPO. So with that, I think we're getting ready to wrap it up. We had a bunch of questions, so I want to thank you all for those questions. That's great. We weren't able to respond to all the answers, and for that, we apologize, but we'll get back to you after the call. We'll reach out directly. Either the presenters will reach out or your service team. With that, I think we are running up at the end of the hour. As John mentioned, if you have any questions on anything that we talked about today, or anything similar to what we talked about today, don't hesitate to reach out to any one of us. Here you have all our information. You have our phone numbers. You have our email addresses. The slides are available. You can download them. Emily, I might need your help here on how to download them. And as I mentioned, don't hesitate to reach out. I did mention at the top of the hour that there are lots of things that were going on that I would somewhat mention. Obviously, if you're aware, there was some legislation that the President signed last night, the Families First Coronavirus Response Act. Went through the House and Senate this week and was signed by the President, and it basically allows or requires employers with less than 500 employees to provide sick leave, up to 2 weeks of sick leave, paid sick leave. So we've already been getting questions. Well, how is this going to work? The government's supposed to fund this. They will fund it. They'll fund it through a payroll tax credit as well, and it's a refundable payroll tax credit. So these will be coordinated with what we just talked about. There's also some more technical, medical leave expansion and stuff like that. Stuff that's way beyond me, but HR teams and our HR provider can certainly help you through the details of what's in these bills. With that, Emily, can you jump in and talk about downloading the slides and anything else that I forgot?
Yep. To download today's slide deck, you may do that now from the slide deck and handouts window that's just to the left of your slide view. We will also be sending the slides and the presentation recording to all of today's participants. A big thank you to Rich, May, Ray, and especially to John joining us from TriNet. We appreciate your time today, and thank you for hanging in there while we all dialed in from our respective home offices. And before you go, I'd like to share a link to a webcast survey where you can provide feedback for today's presentation. We do appreciate your feedback, so please take a moment and fill this out. And thank you again for joining us.